Shifting gears to the European economy now, and it's a crucial week for policymakers in the Eurozone central bank in Frankfurt.
Its boss, Mario Draghi, has given strong hints that the March policy meeting taking place this week could herald a major announcement.
Let's get some analysis now from Richard Perry at Hantech Markets. Richard, latest industry data suggesting that things aren't looking good for businesses in the Eurozone. Is this all adding to pressure on the ECB to act?
Well, it would appear so, and certainly that's what the markets are telling us anyway. And if you look at indicators such as the German two-year Schatz yield, they're going for probably at least a 10 basis points cut to the deposit rate. So there is also other pressure for the fact that there may be further calls for sort of more quantitative easing as well. So I think it certainly sort of comes towards what we're going to be seeing on Thursday, which is going to be further monetary easing from the ECB, certainly.
And is it enough?
Is it enough? Is it ever enough? And I suppose that is the question. I mean, it's further kicking the can down the road. And how many times has Draghi now done this? I think it's 11 times that they've eased monetary policy now in almost 48 meetings. So it seems to be a consistent theme that they're trying to ease the Eurozone economy out of all these deflationary threats that they have, and also low growth. But does it actually work? And that's the big question, because I mean, there's huge questions behind actually the practice of using negative interest rates anyway, and things, and also quantitative easing. And it doesn't seem to be actually doing a great deal, but we'll see.
Well, weren't things starting to pick up for the Eurozone? I mean, if so, won't the Germans seek the same wait-and-see approach as ever?
Well, I think that what we're going to see is, again, another battle on the Governing Council, with the Germans sort of fighting their corner, and the Bundesbank President Jens Weimann really not sort of wanting to go further down the road of monetary easing. And I think that that's what they're going to ultimately have to look at doing, because ultimately they've got no other real sort of tools that they can use. And obviously going down the road of negative interest rates now opens up a whole new avenue, but is it an avenue to another dead end?
Are the markets losing confidence in the central banks?
Well, I think that probably is the argument, isn't it? Because it doesn't seem as though they have actually got the grasp of the situation, even, 8 years down the line now. So it still really is a problem for the markets. And obviously, as I said, with these negative interest rates and the Bank of International Settlements coming in today, and sort of again questioning the use of this new tool that they have got at their disposal, actually whether it's going to do any difference or actually damage the markets going forward. Certainly the banking sector could come under pressure.
OK, Richard, thank you. Richard Perry at Hantech Markets. We'll come back to you a little later. On to the markets now, and most European indices are retreating on the gains they made last week.
Doubts over just how big the ECB stimulus announcement will actually turn out to be later this week have been weighing on traders' minds, as well as that warning that central banks have few options left to reinvigorate growth if it continues to disappoint. Still with us is Richard Perry from Hantech Markets. Richard, first, let's go back to last week. We saw one of the markets across the board, one of the best weeks in recent months. Was it the start of a rebound, or just a pause in a kind of continuing downward, or certainly volatile trend?
Well, certainly the volatility in 2016 has been enormous, isn't it? But I think the rebound that we've got is still being driven by these commodity markets, and certainly the oil price rally has been the big driver of that. Also, you've got copper strongly higher in 2016, and also iron ore, even today, sharply higher on the back of the news out of China and the growth data there, the growth targets. So I think we are seeing the potential for a turnaround. Whether it's sustainable or not, I think is dependent upon, as per usual, possibly this China news. And certainly I think China needs to sort of reinvigorate these markets with more spending. If that is the case, they can certainly help the commodity prices higher, and to hopefully build a sustainable rally in the oil price. But I think the oil price is a two-way thing. Also you got the not only the demand side, possibly from China, but obviously the supply issue with OPEC, and the possible price production freeze with Russia. So if these situations can continue to play out, then we could see a bit of a sustainable rally on the oil price, and I think that is a big factor that we could have in running a sustainable rally in the equity markets.
Well, I mean, talking about the price of oil, we're already seeing somewhat of what you might call a slow but steady rally. I mean, let's not forget, it's only a matter of weeks ago, really, that we were talking about oil in $26 territory. Now it's nudging 40 again. I mean, has the slide well and truly, you think, been reversed now?
Wow. I think it just entirely depends, to be honest, on those two factors, really. I think China being one, but I think the big production freeze, because the market has sort of the big decline in oil came as Saudi Arabia was seemingly trying to price everyone else out of the market, and they've now shifted their sentiment in trying to sort of help the oil price higher. And it seems as though this change of tack has certainly helped to support the oil market, because that's a big player turning around its policy on production. So I think the sustainability of this sort of agreement that OPEC are going to have with Russia could be one of the determinant factors. But I think obviously whilst that is in place, this potential for the production freeze, I think that we're going to see reduced volatility, which is what we've seen in the past sort of week or so, I think, in oil, just creeping higher, nicely higher every day. And that is creating a bullish technical position now that we've got on oil, where you've got the WTI price basing out on a technical basis, and we could see further gains towards 43.50 on that contract. So it certainly is the prospect of further gains, and I think we have got to wait and see how these meetings between OPEC and Russia pan out.
Wait and see indeed. Richard Perry from Hantech Markets, thank you very much for joining us.
Thank you very much.